Okay, well, let's get going. Let's see, who do we have? Still kind of light on people, so let's give it another minute. I know Teddy can't make it. He asked me to record, so I'm recording. Hopefully we'll have a couple more people show up, so let's give it another minute or two. All right. Well, I'm tired of waiting, so let's get going. Okay, so we have so we skipped last week, and I appreciate your flexibility. That does put us a week behind. So tonight we're going to talk about intercorporate entities, which was last week's topic. I think what's going to be best is if we skip chapter 10 that was supposed to be tonight, and we don't do a lecture on it. It's really good stuff, but I think the next two chapters are more important. So we'll skip chapter 10, and it won't be on the final, but you might still be responsible for learning it, because then you might need that stuff for your case study. You know, I don't know what company you've picked, and so how and what issues they run into. So you might have to review this chapter on your own for your case study. Okay, so to recap, tonight we're going to do chapter 9. Next week we're going to skip chapter 10 and go straight to chapter 11. And then the week after that, there's no class because of Easter. And then our last lecture week is April 21st to do chapter 12, when we're going to really start getting into evaluation, the whole point of the class. And then the following week is the final exam. We don't have to do it on the 28th. If the class wants to do it a different date sooner than that, we can discuss that when it gets closer. Update you guys, whatever is more convenient. Okay, and then the case study again, due the 22nd. I'm pretty flexible with that. That's the date we discussed as a class, before or after, but it can't really be too much after, because I have to get grades in. I need some time to grade the case studies. The grades are due at the end of the week, that final exam week. And I haven't really heard anybody about the case study. If you're having any questions or troubles, reach out or ask. Don't want you guys to be stressed or confused by it. The reason why I signed it the way I did was by saying copy the Harley Davidson, but with a company of your choice, to make it as easy as possible. Instead of just having a list of abstract requirements, do this and this and this, I just want you to follow that example as close as you can using the company you picked. Make it easy on yourselves. Just show me that you can apply these concepts to a real world. Okay. Well, with all that said, let's you guys were looking at my screen, right? It was sharing the syllabus. Okay, good. Let's get to the PowerPoint. Good stuff tonight. I like this chapter. This stuff's really important to understand, especially with public companies, because they do have so much of these subsidiaries. So, and as we'll see as we go through the lecture, how the subsidiary is represented on the balance sheet and income statement varies wildly. So it really changes how you look at this stuff depending on how it's accounted for. Okay, there we go. Great. Okay, so you should be seeing the PowerPoint. So let's get to it. Okay, so intercorporate equity investments, where one company buys into purchases the voting stock of another. Right, so why would we do this? Lots of different reasons. Sometimes companies have lots of cash. I mean, tech companies tend to have tons of cash. And what are they going to do with that cash? Well, sometimes they pay it out in dividends, but most of the time, especially with like a tech company, they don't want to pay out dividends. They want to grow. So they do stuff with their cash, like put it into short-term investments, buy stocks, buy bonds, buy other securities, in order to, so that cash is not just sitting there, it's earning interest or increasing in value in some way. So short-term investment of excess cash is a common reason why you would why a company would buy these intercorporate investments. Another big one is strategic alliances. Having cash on board to buy into a company you want to do something with. Big in pharmaceuticals, where there's this huge investment R&D costs. So having cash on hand to do a joint venture or buy into another company that's working on something similar. To buy into a company to advance your supply chain, or that is in a market you want to enter. Buy a company that's really good at making things. So like one situation I was involved in as a lawyer was a company that had a new way of making a machine, and that made ice as kind of what they call it flow ice. So instead of ice cubes, the ice came out in a semi-solid state to be able to like coat a surface. And this was used in like food production and like fishing, to coat the fish in ice in such a way that it kept the fish at a constant temperature when it's out at sea. And things, any kind of thing where you needed this kind of like non-cubed ice that can be malleable to a size. Anyway, so they made a strategic alliance with a production company that made machines. So the company A had the design and technology to build the machine, and they didn't have the production facilities. And instead of just hiring the production company to make the machines like you would like you normally do, they actually made a strategic alliance, bought it into each other's companies. So that was a strategic alliance example. Okay, other ways of doing this is as a targeted project. So I mentioned joint venture as a strategic alliance. It's really on its own thing oftentimes, but joint ventures when two companies come together for a specific defined purpose, to do something. And they'll sometimes they buy into each other's stock, sometimes they form a separate company or to handle this project. Market penetration or expansion, expanding horizontally or vertically is very common, expanding in existing markets. So we, this is common, like, like Kaiser, my day job does this to expand into both new markets as far as products, service lines, and new markets as far as geographically, where, so let's say we want to start offering a product that we don't currently offer. One way of doing that is you find a medical group that's offering this new service, whatever the service might be, and you buy them. This is what United Health is doing. This United Health which is Kaiser's competitor, is spreading across the country by going into new service lines, by buying the medical groups that know this, that have this expertise, or buying into medical groups that are in an area, a state they want to get into. Very, very convenient when there's high barriers to entry, like medical, for example. So you can't, doctors have to be licensed, the facilities have to be built in certain ways, they're very expensive, building up clientele is difficult. When there's higher barriers to entry, it's much easier just to buy into a company or buy the company doing it. Okay, so we have all these different reasons why you want to do it. But what does it mean for your balance sheet, or what does it mean for your financial statements? Well, the difference is about the level of control. So if you have control over a company, and we define it later in the lecture, in the chapter, but typically it's you have control over your strategic operations, so in management. So this is typically like 50% or more of the voting stock. So you can vote in a board, and the board you control now can hire the officers that you want. If you have control, then it's consolidation, and it's a fully integrating the subsidiaries' financial statements into your financial statements. If there isn't that level of control, then there's two different ways of doing it. If you have little or no influence, like you just own like 1% of the stock up to 10% of the stock, which means you're not getting a seat on the board. You have no ability to say what the strategic objectives of the company are. Then you just put them on your books at the fair market value. If you have significant influence, but less than full control, then you do an equity method, which we'll get into. So there really isn't defined levels where these different levels of control trigger. So the book says, up to 20% is little or no influence, and 20 to 50% is significant influence, and over 50 is, but that's just a guideline. Just because you have 49% doesn't mean you don't have full control of the company. If there's other agreements or legal agreements, or other ways that you have influence in that company, might put you over that full control. And this is an area, I think we've already established we don't have any like accounting majors in our class, but this is an area where like there's really a difference between accounting and finance, where accounting likes rules, and finance doesn't like rules. So this is more of a finance analysis. This is, let's look at some indicators and see where we fit, and it can be very vague, and it can be very much a thing where it could both ways could work, and you pick the one that works best for you, and you have to back it up on your 10K. Okay. So the little or no influence is passive investments, right? Less than 20% outstanding voting stock, small investment, and the main thing is you can't exert any influence into the investee. You literally just own some stock. That significant influence, 20 to 50, right? And this, yes, significant influence is if you have some ability to exert influence over that company. So if you can get a board, if you own 20% of the company, but you get a board seat, which happens, especially if you're acquiring into a small growing company that needs you, needs that investment. You can negotiate a board seat. Then you would be a significant influence, even at very low ownership levels. If you have legal agreements, right, to use technology or patents. And then again, the full control, there's a couple different tests, but really this is that you have, some actual control over the destiny and future of the company. Okay, so how we account for it is different. So the fair value method is when you very passive, you don't have any control, and that's what we're going to start with first. So we're going to just report every accounting period where you're doing your statements. You're reporting the fair market value. And then at the equity method is a little bit different, where you're reporting your portion of the equity on your financial statements, and the subsidiary or the investee reports you on their statements. And then if you have full control, it's just full consolidation. So the publicly available financial statements account for all assets and liabilities of the investee on the investor. Okay, so let's talk about that fair market value. Now, this fair market value is weird when we come to these investments, because it's one of the very few times where we report on the financial statements unrealized gains. So nowhere else, or very, very rarely, do we account for unrealized gains on balance sheet and income statement, except for here. So so when we do this, so that's a little sneak preview for the next couple of slides, but so you make passive investments through typically marketable securities. So buying stock on the open market of a public company is a very common one. You can also buy other types of securities, securities that are tradable, and then also non-marketable. So shares of private companies, ones that are not publicly accounted for. So this could be everything from privately held, LLC, privately held companies. This could be a pre-IPO startup. The many different ways this can be. So it can be marketable and it can be non-marketable. Okay, so you buy into it. You buy 10% of X company. You report that purchase price of the whatever price you're paying, and then when you sell, you divest those shares, some or all. You report the recognized gain or loss. All right, so that part makes sense, just like you would have at any other kind of investment we've learned, is that you put your purchase price and then you put your sales price, and then you can recognize the gain or loss. But here's where it gets a little tricky, is in this example here, we see that this example, they purchased 1,000 shares at $20 per share. So they used their cash, so cash asset went down, and their non-cash assets, these shares that they own, they're worth 20,000, are put in non-cash assets. And then at some time later, they sell 400 of those shares. So they got this cash in 9,200, and then they lowered their non-cash assets by the number of shares at the book value, which is 8,000, and then they recognize the gain of sale of 1,200. So on the balance sheet, goes into retained earnings, and then on the income statement, revenues of 1,200 there. So interesting little twist there. Okay, so now let's take that twist a little further. So in every reporting period, even if there isn't an actual recognized event like selling the shares, you're going to make changes to that fair value. So fair value, you know, they call it fair value method of accounting is what we're talking about here. So how do you get that fair value? Well, luckily, for the most part, companies are buying into public shares. So that's really easy to figure out their fair value. So if we have 1,000 shares, we bought them at $20 in the last example, and we still own all 1,000 the next quarter, and we're updating our statements. And we can just check if it's a public company, we can just check the New York Stock Exchange or whatever exchange is listed on and say, oh, it's now been traded at 23. So we've had a $3 a share gain, and we recognize that on the financial statement. That's a level 1. So it's really easy, but not everything's so easy. So there's level 2. And this is where we can go and say, maybe it's not publicly traded, but maybe it's a company that's very similar to a publicly traded. Maybe it's like a semiconductor maker, and we can like go and look at, it's not publicly traded yet, but we can go look at what Intel is being traded at, or we can go, or earnings per share, or some indicator, or maybe we can go look at if they're selling GPUs, go look at a GPU manufacturer and look at what their costs, their average costs and their average revenue is, and figure out some comparison. That's a level 2. So using easily available market data and that somehow is applicable to what you're doing. And then of course there's level 3, and this is like pretty common, like some areas like the tech world, where you have no unobservable inputs. So it's a startup and a new tech, and there's just nothing to compare it to. You just have no idea. So you just have to come up with some reason, some rationale of how you're evaluating. Okay, so this is an example of how you put that fair market value. So in this particular case, the $5 increase in fair market value, it's an unrealized gain. So on the balance sheet, you already, when you purchased it at $20 a share or whatever, you've already put on your non-cash assets to 20,000. Now it's gone up 3,000. So you add to your non-cash assets, and you add to your earned capital, even though there was no event, there was no actual trigger. This is all on paper. It's all fictional. And then your income statement, which is really weird, I think, but this is how we do it. You put in that 3,000 unrealized gain on your income statement, even though there is no actual gain. There has not been an event to turn this non-cash asset into cash. I think they do this in part because it for level 1 and 2 is pretty easy and quick to turn it liquid and turn it into cash. Anyway, so that's what, remember out of this chapter, when you're talking about these equities on a balance sheet or an income statement that's from a passive investment, this is unrealized gain. This is still holding on this paper, stock paper or whatever. It's not actual cash. Okay, and here's an example from Alphabet where they list on their 10K, right? They list how much level 1 they have and how much level 2, and then define it. So like level 2, they're holding these mutual funds, which they can fairly accurately gain the value from observable data, but it's not a market traded amount. Okay, so that non-marketable equity security refers to stock, right, when there's no publicly stock available price, and this is pretty common. I'm working on I guess I can't really disclose much about that, but if you have a wholly owned subsidiary or you're buying in, I guess wholly owned would be the last part, but it's quite often that you're buying into a startup, you're buying into a small company because, give them a boost, and you're just buying in like 10 grand. and you have nothing to compare it to. And this is pretty common, especially when you're buying, when a company's growing and you maybe you're considering, do you want to buy, let them grow a little bit to see if they can build up a market base or whatever, or finalize their technology. So maybe you buy in 10% to give them working capital. So they still have to be reported at the fair market value, but it's really hard to come up with that. So you would look at as much as you can, look at, discounted cash flows, or if there's any competitor out there that is public, some kind of realistic, consistent, passes the laugh test method. Okay. I don't know why sometimes the book goes into this, because it doesn't really affect us anymore. But in 2018, there was this rule change that went from requiring companies to not requiring them to put unrealized gains, and then now accounting for them. So this example from, I think, Alphabet shows that their other income was pretty low 2016, 2017, because they were just showing the book value. And then 2018, suddenly it quadruples. That's because they then have recognized in all their passive investments, all this unrealized fair market value gain. So of course, going forward from 2018 on, this is how they're doing it. This unrealized recognized gain. I guess if you're going back in history to compare 10 years ago, you would be able to see understand what that difference is. Okay, so it's not just equity. This also applies to debt securities. So corporate bonds, US government bonds, municipal securities. And here, the more nuanced approach is that how is it treated on the balance sheet is going to be determined what the plan for the debt is. So if you're going to hold it to maturity, then you're not recognizing anything on your income statement, because it's just going to be the fair market value is what it matures at, which is already counted in when you bought it. But if you have available for sale or trading securities where you're not going to keep it to maturity, you have no intent to keep it to maturity, then you have to account for it in the accounting periods. All right, so this is held to maturity, right? So you don't put it on the balance sheet or the income statement, except for when you bought it, and then when it matures, and or if you change your mind and sell it before it matures, then you would recognize it and realize it. Okay, and another thing is we're starting to introduce this amortized cost, which we'll get to again this chapter. Some things you amortize, and some things you don't. So here you would amortize these at the initial purchase. Okay, so but then available for sale. So these are ones you're holding on to. You're not expecting to hold them maturity. You're going to keep them available for your cash needs, and which means that you're going to sell them at the market rate, right? So you're not holding them maturity. You're going to sell it as on the open market as you need cash. So then you account for the fair market value, and you put these in the accumulated other comprehensive income category. So just like before, you increase your non-cash assets, but you also increase your earned capital subcategory AOCI. Okay, and here's Alphabet's example where they're telling you they have level 2 and level 3 debt securities, and how they're listing it all out. The adjusted costs, if they have unrealized gains, unrealized losses, what the fair market value is. And just like with the equities, some of these are level 3. So they're doing some method that passes the laugh test, if they had to explain it, that to come up with a realistic estimate. Okay, so then they actually go and sell it, and now they have to go, but you have to go back and account for the actual realized gain or loss, adjust for what you've been putting in for your fair market value all this time. So reclassify it. Right. Nothing fancy there. Just like anything else, when you go back, when you actually realize it, you have to go, you go back and adjust any assumptions that you've been making that whole time. Okay. Yeah, so financial statement disclosures. Companies are required to disclose the cost and fair value of their passive investments. So it's on their balance sheet, on their 10K. Okay. So that was that first. You have no control. Is passive 10, 20% or less of a company. You just do the fair market value with some nuance there. Easy. Now, what happens when you have some control, but not complete control? So some influence, but not complete control. Then you do this equity. This one gets a little bit more tricky. So why are you doing equity investments at this significant influence? So this is a lot for strategic reasons. So you can get a seat on the board of directors, start influencing the board of directors to then accept the offer later on, or to learn about the company, its products and industry. This is like very like almost Machiavellian. Like you buy a way in and start mining the data on your competitor. Or maybe it's a strategic alliance. So you're building up this level of intertwining your companies to get to a point where you want a strategic alliance, or pursuit of R&D. The pharmaceutical industry is big on this because they cost $8 billion to develop a new drug. So they'll make a strategic alliance and at different levels. Okay. So you can have lots of forms of this. So you're going to buy you can buy like 40% of this marketable securities. You can form some kind of partnership, some kind of joint venture, which can take the form of a legal entity, or it can take the form of buying each other's ownership interest. Right, but we're always going to be looking at what the underlying intent, what the underlying impact is, and is there significant influence? And if there is, then we do this equity and equity method. All right, so I think they define it here more. The significant influence is the ability to affect financing, investing, operating policies of the investee. We look for things like gain a seat on the board of directors, if the investor controls technical know-how or patents, right? So I can buy in at 19%, which is under that 20% threshold. But if I control the patents that you're using as a critical part of your company, then I have a lot of influence. So then we do the equity. Okay. So what you're doing with the equity method is you're reporting the balance on the balance sheet, the percentage of the investee's equity owned by the investor. So you record it, you start out the purchase cost, right? And then you're updating it, not on the fair market value like we were just talking about, but as your percentage of the investor, how much you own of their retained earnings, of their profit. So if you own 30% of the company, you own on paper 30% of the equity. So you have to report that on your books. And then dividends are also then reported. Dividends that you receive are then reported in a special way too, where they're reported as lowering your non-cash ownership interest. Right? We don't care about the fair value at this point. we're caring about the real world numbers off the investees books that affect our ownership interest, but just some of them, not the full amount. We don't really care about liabilities. We don't really care about revenue, a little bit, but we really don't care about liabilities. So what this looks like is buying in 30% of this company on this example. So they buy in step one, right? 300 cash gone, and in exchange for 300 of investment, non-cash asset. And then at the next period, this investee, this subsidiary, has income of 100. And the investor, Google in this case, owns 30% of the company. So they recognize, Google in this example, recognize the 30 increase in their non-cash assets. And they equal it out, 30% retained earnings, right? And then on the income statement, 30 equity income. Here's the weird thing. I mean, I think it's weird. I don't know, maybe you guys won't. Just because the subsidiary, just because the investee had income doesn't mean Google gets any of that. Like, there's no cash transaction. You don't just give your investors, your shareholders, money because you have revenue. That's not how it works. So the investor here, Google, is recognizing an increase in their equity and an increase in their income, but it's a purely paper. There's no transaction. It's not realized. No money has changed hands from Mintel's, in this example's, accounts to Google's accounts. Okay, but then step three is at the end of the year, Mintel here paid out dividends. So they paid out 20 dividends total. Google gets 30% of that. So there's now, this is a cash transaction. Cash went from Mintel's bank accounts to Google's bank accounts, and they recognize a cash increase of 6. And then, a little nuance here, it's accounted for by decreasing on Google's books their equity investment. So they increase their non-cash asset by the amount in the dividend, but there's no income statement. Again, I think it's weird, but this is how we do it. And then the ending balance of Google's investment is the original amount plus the unrealized but recognized increase in value of their investment, minus the actual cash that they've gotten for dividends.
Why is it like a -6 in the investment? Because Google isn't actually losing like 6% of the investment. What's kind of the logic behind that?
Okay, so I'm gonna caveat my answer with, this is what I am guessing, right? So I don't know the definite answer, but I sat there and I pondered this. And maybe I did know it at some point when I got my MBA, but I've since forgotten. But as I was prepping for the lecture, I pondered this too, to figure out why this is. And I think it actually makes sense if you think about it, because when you pay out, ignoring Google for a second, when you're making a decision, when you're making a decision to pay dividends, you're paying dividends from your company, from your owner's equity. So you're actually paying out part of each shareholder's equity. So when you pay out dividends, you're actually lowering each shareholder's ownership interest in the company. Now, it doesn't lower the percentage of interest because everyone's getting an equal dividend. Every share gets an equal dividend. So everyone keeps the same percentage, but that each percentage is worth less because you're paying out some of that retained earnings. So I think that's the same logic here, is Google still owns 30%. It's just each 1% of each percent of that 30 that they own is worth less because now the company has paid out some retained earnings.
Okay, so it's like, I guess they paid out, or if they had like retained earnings of, just for simplification versions, like 200, and they paid out $6 of that. So then they'd still own 30%, just 30% of,
Yeah, it's just that
200
30%
minus six.
worth less.
okay, that makes sense.
Yeah, and that's why, I mean, and that's why it's important. I mean, that's not really, it's not ever done any other way, but important to remember that the dividends are paid out per share. So every shareholder's interest is decreased by the same amount. So there's no percentage change. So that's why I think that's why they do it like this. But that did take me a minute to figure out why they did it like that. Okay, so what that looks like on the balance sheet here is that, so on Mittel's income statement, they had income of 100, and that gets translated to Google's income statement of 30% of their income is technically owned by Google. So Google reports that 30 on their income. And then on Mittel's balance sheet, their new equity position at this time period is 1080, which translates to Google's equity position is 30% of that, right? And 324. And I guess now that we can put the pieces together, it makes sense why they reduce it, because Mitel's balance sheet, this equity number after the dividend is reduced because that dividend is reducing the retained earnings. So Google has to have it as a subtraction as well, so it's consistent. Okay, so this is all assuming that you buy into the company at a fair market value. You know, the book value is the fair market value, and certainly if you're buying marketable securities, that's probably the case. Not always, but probably just buying on the open market, and so you're buying at the market value. That's not always the case. Even public companies buying securities, when like a hedge fund's coming in or a pension fund's coming in, they're going to buy 30% of the company. They don't just buy at the market rate on the stock exchange. They don't just call their broker and say, buy me at the current price. It'll be a negotiated, structured price at a certain share price. And then when it's not a public company or it's publicly traded, you're buying above or below the book value or the fair market value for various reasons, mostly strategic reasons. So when that's the case, you account for it on the market value, whatever the market value would be. So if it's assessed in this example, 300 was the market value, but Google ended up paying 400. They account on their equity method for the 300, and then they have to account for that extra 100 that they paid it for whatever reason. So why did they? And this is a management's choice, you know, dealer's choice, management choice, however they can spend it, they get to do. And the reasons why they paid extra could be lots of reasons. It could be that they have there's some assets that they think is worth it to them to pay extra for, and in which case they attribute that extra 100 to add to that asset, and then they can depreciate it over that asset's usable life. What if it's identifiable intangible asset like a patent or something, same kind of thing, and amortize it over the lifespan of that. But what happens if it's goodwill, which is way common? I don't know how many times. I mean, I practiced this area of law for like a decade, doing these purchase and sales agreements, and 99% of them had, we're buying the property for this value, some low value, or buying the computers and equipment for this value, right? And it adds up to like 10% of the purchase price, and the rest is 90% goodwill. We're buying the goodwill. They love goodwill because it's really easy. You don't have to come up with how you're evaluating it. It just says we're buying the goodwill. When you're buying the goodwill, it's not identifiable what that is, and it's not tangible, which means you don't amortize it. You can't depreciate it. So it has to be accounted for that way. So essentially, it just stays on your books the way it is, unless it gets impaired. So as we learned in earlier chapters, impairment is every now and then you have to take a serious look at that asset and determine if it can ever live up to the value that's been assigned. So if you bought in a company at $100,000, and then realistically after 2 years, there's no way that the assets that company holds plus the customer revenue and cash flows would ever come near recouping, then it's impaired and you have to write it down. Okay. So with this equity method, let's talk about the issues. So you're not recognizing with a fair market value, you're recognizing unrealized gain, but with the equity method, you're not until it's sold. And sometimes we could talk about, and it's impaired, it's permanent, the investment has permanently declined, so that's not recognized on the books unless there's an actual impairment analysis done, which happens yearly or regularly if you're doing it right. It does not mean the investor has received any income in cash, right? So like Google's recognizing their increased value of 30, but there was no cash. They only recognize the cash when it's a dividend. So can be very misleading if you're not understanding what to look for. Okay, so this is an example of that how it can be misleading from the book. So I don't know if it's worth getting into this. So essentially what this is saying, what this example from the book was saying, that in this Altria owns 10% of the voting interest of AB InBev, which I think makes beer and some other consumer packaged goods. And so they have on their Altria, the parent, the investor has 17 billion on their balance sheet, but if you look at AB InBev's, if you look at 10% of what their liability and equity, or if their stockholder equity 65 billion, 10% of that is only $6.5 billion. So why is Altria showing 11 billion more? So it can be misleading. Why is there a difference? Well, there could be lots of reasons. And one reason is with the equity method is you don't have the liabilities aren't accounted for. So look at AB InBev here. They have total assets of $228 billion. They have a significant amount of liabilities, and that's not accounted for in this equity method on the investor's books. So what the investor here is doing is they're making their own judgment to come up with a value that compensates for these issues, and they added 11 billion. Is their assessment of what the goodwill and trademarks of AB InBev are worth. Okay, so because of that issue where like the liabilities and other areas off the balance sheet and income statements are not accounted for in this way, it can throw off some of the ratios. Yeah, so like net operating profit margin. So the investee sales are not included, right? So you look at this ratio, and I think I wish it said it here because I can't remember what the exact ratio is, but you'll have the ratio, whatever statistic over another statistic, and that gives you the ratio. Well, the problem with this equity method is if you're not counting liabilities or you're not counting sales, then you'll have one of the numerator account that for the investor accounts for, the equity, but the denominator doesn't. The denominator doesn't have the liabilities of the investee or whatever. So that throws off the ratio. So you have to be very aware of that. You can adjust for this stuff. I don't know how often you have it. So you have these other ones, financial leverage and net operating. Again, it's all because the liabilities or the revenue or something is left off of the denominator or the numerator. Does it matter? Typically not, because ROE is, the ROE statistics are typically not affected. So if you understand that some of the other ratios can be, you can adjust. When do you adjust? It's actually pretty rare to adjust some of these. There was in the book, there was one of these sidebars where it's talking about when to adjust it, and they list out the scenario when it makes sense. Yeah, let me see if I can just find it real quick. Yeah, okay. So the big concern, I found this interesting, so I just want to bring it to your attention on page 917, is the analysts will adjust this when they think that the investor is responsible for the investee's liabilities. So then, if that's the case, then it becomes very important to factor in the investee's liabilities into the investor's analysis. Okay, so remember from your business law classes, very rare. I mean, the whole point of having a separate entity is that only that entity is responsible for its own liabilities. So this is a rare scenario. So when would this scenario come up? The investor might be legally responsible for the investee's liabilities under circumstances if they secure a contract. So maybe the investee can't secure a contract to buy so many whatever input supply widgets, and the investor uses its financial power to back up the contract for them. So we'll pay if they don't, or to secure a line of credit. These things happen in the business world, especially if there's going to be a strategic alliance at some point. So we'll help you get more set up financially. So if there's a legal contract where the investor has agreed to co-sign, that can happen. The other thing is if there is some kind of strategic reasoning here. So investor buys in 40% of investee, and investee, it doesn't sign any contracts, so the investee can go out of business, go bankrupt, and investor isn't legally obligated to pay for any debts. But investee, if investee does go out of business, investor, one, will lose their investment, or maybe, but more importantly, that potential for strategic alliance was their way into a bigger strategic picture. So rather than losing that, they would increase their investment or pay off a debt on behalf of the investee. So in which case you would want to know what the liabilities are. But outside those two cases, the liabilities of the investee are irrelevant to understanding the financial picture of the investor. Okay, so let's go on to the third way, consolidated. So this is going to be your wholly owned subsidiaries. This is going to be when you owe 80% of it, when you owe 50%. Why did I take out those three things? Well, those are the three most common percentages to own. You own 51%, so you have control of the voting block and you can vote your own directors in. You own 80%, which is a trigger for some financial regulation. If you own 80%, you for some other areas of an IRS, you are considered the same entity if you own more than 8% of another entity, for as far as like your pension and your 401k, how they're, those are rated if you're keeping within compliance with those regulations. And then 100%. So it's very common to sort of to have a wholly owned subsidiary. You own 100% of them, but you're transferring risk to them. So that's that whole, like, if they sign a bunch of contracts and they go under, the investor isn't liable. Okay, so GAAP requires consolidation of the financial statements when you meet these tests for total control. All right, so in theory, the abstract way of this is if the investor has the ability to influence the investee's decision making, can influence the investee's financial results, can expose, and then the investor is exposed to variable returns from the investee. The investor has rights to receive residual returns. So these are all elements of what it means to have control. But there's actual tests. So the first test is this variable interest entity, VI. So if it meets this test of the VI test, then you have to consolidate. If you don't meet the VI test, then you still have to test to see if you have control through voting stock, in which case that's typically 50%, but other factors can influence that. Okay, so when you consolidate for a public company, this doesn't quite apply the same for a private company. But if the investor or both companies is public, then for your publicly disclosed financial statements, your 10K, your once a year, then 100% of the assets and liabilities for both organizations have to be accounted for on the parent organization's financial statements. So that means all the liabilities, all the assets, all the revenues have to be accounted for. Okay, and then any transactions between the two entities have to be, eliminated line by line so that there's not double counting of those. Okay, so okay, so I think this is pretty self-explanatory here just by looking at the financial statement. So we can see here the parent company lists their investment into the child company at 3,400, and then the child company is lists that 3,400, breaks it up into what their contributed capital, so the 2,000 original, plus this 1,400 retained earnings. Okay, and then you look at the line, you go to the third column here, the consolidated adjustment. So when you consolidate it, you have to account for the differences. So on the consolidated statement, you subtract out this 3,400 investment back to zero. And then same down here, you have to subtract out from the contributed capital earnings of the sub companies, contributed capital retained earnings, to get the consolidated amounts. And then this $400 for the NISM company net income becomes the equity income of the parent company. But then on the consolidated return, you have to subtract that out. Otherwise, you would be double counting. All right. So I don't really think this is a hard concept. I think there's a lot of accounting rules that we don't really have to understand because this is not an accounting class. But essentially, you go line by line and you match up the areas from the parent company where they fit into the sub company, and you subtract out where it's double counted to have the total picture on the far right column. Okay, so that's for a wholly owned subsidiary. But that's not always the case. So here's one that's example is 80%. Remember, 80% is a very common trigger because of these financial regulations that trigger things at 80%. So it's the same kind of thing. So the difference being, though, that that this parent company has the same recognizing liabilities and net income and all this stuff, but only 80% of it. Right. So the net income down here of the sub company is 400, but the parent company only owns 80% of that. So they only recognize 320. But then you have to go down to this net income attributable to a non-controlling interest, which we've talked about in previous chapters, but we really didn't get much into it. And this is where this comes into play, where the parent company, or the consolidated report of the parent company, you put in there this amount of money that has to be attributed somewhere that it doesn't belong to the parent company, it belongs to the other investors. Okay, the same thing when you purchase it above book value, you just have to account for it, and you can amortize it or depreciate it if it's for a particular thing. If it's goodwill, you don't. All right. Same kind of, I think it's just really self-explanatory. I really don't think the consolidated is that hard to figure out. Let's see here. Yeah, so here's an example of the impairment that they found in this 10K from Heinz. So Heinz had to realistically account that there was an impairment to one of their consolidated entities. And they had to write down, I think they're the ones that had to write down. So they wrote down like 15 billion on this consolidated entity. There was another example, which I don't think is in this PowerPoint. There was another impairment example in the book that was interesting, that the management classified it as a temporary impairment. And they had some reasoning why they thought it was temporary. And because of that, they didn't have to write it down in the consolidated books. They kept it at the normal value, saying that we expect the impairment to end after X amount of time. So that was really interesting. And I don't know much about that, but the legal requirements where you can get away with saying that this is a real impairment versus a temporary impairment. Not that I think it matters, because it looks bad to impair 15 billion, but you're writing it down, so it's lowering your tax liability by 15 billion. And if you don't have the profit that year to account for that, you just carry it over for a few years. So writing it down, impairment's not a bad thing for your books. Okay. So the intangible assets, so tangibles, the PPE, inventory, you depreciate it. Intangible, same thing. I think we were already talking about this stuff. Right. So you just same kind of classifications for the consolidated. Let's see what else. I think we're kind of. Yeah, so foreign subsidiaries, it's all the same thing, but you have to account for the translation from the foreign, whatever the foreign company's currency is, converted to US dollars if it's a US parent company. We've already learned how to do that. Just really a reminder that you still have to do that when you're consolidating. I don't really think that that's too interesting. Yeah. So yeah, the limits of this consolidated reporting, the same kind of thing we already learned. So you're recognizing unrealized cash. And I think it makes a little more sense because you're just consolidating the balance sheets and the income statements and the other financial statements. So the same rules that you already know how you look at a balance sheet apply. So you already know where the areas of your own balance sheet where you're recognizing unrealized, you're recognizing just on paper your cash when you don't have it. You're just consolidating that. I don't really think this is as big as an issue as the fair market value and equity was. And just as a reminder, this is kind of reminding us that under most cases, the parent company is not responsible for the unguaranteed debts, but it can happen, but very rare. Yeah, so this is the last bullet point. Creditors are legally forbidden from suing and seeking payment from the parent company under most circumstances. And that's the whole point of having a business entity. Legally, that's the whole point, to limit liability for the shareholders. So just because a shareholder is a company, maybe even a very successful company, doesn't negate that whole purposes of limited liability. Okay, and a big company like Google or whatever, the consolidated tax return, or excuse me, consolidated financial statements, it's a lot of consolidation because they have a lot of entities. So it can be very complex how it's consolidated. So you need to pour through that if you're looking at a company like Google or something, you really get to understand. I don't know how much we need to get into this. Let's just quickly go over the hedging risk. So you can hedge risks. You hedge risk by having a derivative or some other financial transaction that's negatively associated with the primary financial transaction. So if you're having some kind of derivative agreement, that it becomes more valuable as the asset is tied to becomes less valuable, and vice versa. So that's accounted for here on these methods. This is very common in these subsidiary, these investments. So I don't know so much why this is important, other than to understand this is a concept that needs to be accounted for. So common derivatives, so like hedging against price volatility. So like Tiffany Company, that they'll hedge against volatility in the metal commodity prices. What else is that? Oh, like Southwest Airline hedges against jet price purchases. So like, how do you do that? Well, there's a couple different ways, but one thing they like to do is buy jet fuel when it's cheap and store it, and then hold it till it's expensive. So that's one way of hedging it. I don't know, there's a lot of different ways. Really fascinating stuff, way above my head of how complex this stuff can get. Yeah. So like this says, hedge accounting is complex and derivative footnotes are among the most difficult to interpret. Right, for a reason. These transactions are so obscure. They don't want to be transparent for lots of different reasons. And in your footnotes, the companies don't want to be transparent because it's showing where it's announcing to the world where they see a weakness in their own business and business model. You have to there's a minimum amount that has to be disclosed. And you certainly want to disclose to your shareholders that you're being judicious with your money, with their money and risk, and you're protecting against, but you don't want to give too much detail because that then exposes where you know your weaknesses are. Okay, so yeah, so the fair market accounting hedges are, derivatives are subject to this, but they're negatively correlated. But you would put in the fair market of value of those hedges. Yeah, again, I don't know how important it is for this lecture to talk about this stuff. Yeah. So there's equity carve outs. Let's just quickly go over this. So this is when you divest. So why you divest for lots of different reasons. Nothing too strange about the divesting. You know, you book it the way you would any other kind of selling an asset. Do it for lots of different reasons. One reason that's pretty common actually with big companies is regulators might insist that you divest the practice line, so to get around antitrust and other issues. So if you're going to buy your competitor in a different region, you know, a Safeway is coming in and they want to buy out the local supermarket chain, or for even better along those lines is the private equity company that bought Albertsons then came in and bought Safeway, and regulators said, we'll approve this, but you have to sell 13 stores in this particular market to another competitor so that you don't own 100% of the grocery stores in any area. So that's pretty common. Regulators will say you have to divest certain lines of business in order to move forward with whatever. Maybe it just goes against your strategy. Maybe it's no longer making money and you want to divest that business line or the subsidiary. Yeah, so there's sell off. So you sell off the sub to an unrelated party. There's an IPO where you can have that company go public, which is really good because then you make lots of money because you own 100% of the shares or whatever, 50% of the shares. Not quite related, but earlier in my career, I worked for a nonprofit called the Casey Family Programs that was started by the founder of UPS 100 years ago when UPS started. And UPS was private up until like 1999 or 2000, right around there. And they finally went public then. And the nonprofit that I worked for still owned from 100 years ago when it was started by the founder of UPS, all these private shares of UPS, and just overnight, when it went public, gained like 10 billion in value. And because it was a nonprofit, nonprofits can't profit, so you have to spend so much. So they had to spend like 2 million that year, or excuse me, 2 billion that year. So it was incredible the amount of expansion that they went through. But that kind of thing happens. So if it's a public company or a private for-profit company owning subsidiary, they can have a huge cash infusion from the IPO. Spinoffs and split-offs, very similar, with a minute difference. So the spinoff, the parent declares a dividend and instead of using cash, distributes all the shares. So just like we learned in previous chapters, dividend with shares. Split off, the company repurchases its own shares using the shares of the subsidiary company. All right, same effect. This is how it all example of how it all looks on the books. Yeah, I mean, I don't think there's anything new here. Okay. Yeah, I don't think we need to get into this stuff. Okay, so that's good with the lecture. Let's assign some problems. Who do we have? 1, 2, 3. We have 5 people. Is there any questions while I'm looking this up? Is anything come to mind? No. Okay. Okay. Marios, you're first because you're in the left top of my screen. 9.1 and 9.2, 9.13. It's like 9.13 is a gigantic question. So, or excuse me, 9.14. And so you do 9.1, 9.2, 9.13.
Okay.
Nicholas, do 9.3 and 9.4. And then attempt 9.14. I'm just glancing at it now. If this ends up being a nightmare problem, just do the best you can, but don't kill yourself on it.
Will do.
Nathan, let's do 9.5 and 9.6 and do 9.15. Chris, 9.7, 9.8. Yeah, 9.7, 9.8. So yeah. And do 9.17. And who do we have left? Cal, 9.10, 9.11, and how about 9.18? Okay, that should be everyone. It's 8:27, so we'll come back at 9 and go over them. All right, should we get going again? Okay, well, let's see. Who did I forget who had 9.1? Let's start there.
I did.
Okay, well, go ahead.
Okay, what is passive investment and why do companies have passive investments? It refers to buy and hold portfolio strategy for long-term investment horizons with minimal trading in the market. And I think companies have passive investments to maximize returns by minimizing buying and selling in the market. It's a cheaper method, less complex, and also offers, it produces superior after-tax results over medium to long time horizons than actively managed portfolios.
Yeah, I mean, I think that's that's all right. I think the other thing, let's not forget, is if you're sitting on $1 billion or 60 billion or whatever Microsoft has, 160 billion, you don't just sit in cash and watch it lose value with inflation. You want to put it in something. So passive investments in the stock market or debt securities makes sense, so you don't lose value of that cash.
Yeah.
Okay, 9.2.
What is an unrealized gain or loss? Unrealized gain is an increase in the value of an asset or investment that an investor has not sold, such as an open stock position. And a realized loss is a decrease in the value of an ongoing investment. and both remain subject to change, but they can help minimize the taxes owed.
All right.
And M913,
Mhm.
the one where Bava Company purchases 23,000 common shares of Jones Company for $12 cash per share. Bava receives a cash dividend of $1.30 per common share from Jones, and the year-end market price of Jones common stock is $13 per share. How much income does Bava report relating to this investment for the year? I found total income of 52,900. I did 23,000 times 130 cash dividend, and then 23,000 times $1, and I added both.
Yeah, okay. Let's see here. So if we break it out, I think you're right. Let me just work through the math here.
Yeah.
So 23, the first transaction is 23,000 common shares at $12,000 cash per share. Okay. Yeah, and then the dividend of 130. So the dividend, though, is not reported as, so it's reported, it's not reported on the income statement, but on the balance statement. All right. Yeah. No, I think you're right. Yeah, I was just running through the math. So, okay, good,
Okay.
good. All right, who had 9.3?
That would be me. All right, so 9.3 is where unrealized gains and losses related to marketable equity securities reported in the financial statements. They're reported under other income, and that's within the equity section of the balance sheet.
Unrealized gains and losses, unmarketable equity securities reported on the financial statements. Yeah, so there's two places, isn't there? There's the balance sheet and the income statement. Does that sound right? Unrealized and marketable securities.
I'll take your word for it. I couldn't really figure it out. I was just looking through the slides and I saw it pop up. I'm not sure which slide it is now, but that sounds about right.
Yeah. So unrealized gains. Why is this? We just went through this. Why can't I find the example either? Yeah, okay. So here, let me share the screen real quick. Okay. So unrealized gain. All right, so this is the fair market value has gone up. So non-cash assets, the value of those non-cash assets goes up by that unrealized gain, earned capital on the balance sheet. But then the income statement, revenues go up by 3,000 and net income go up by 3,000. So remember though, this is all on paper. There's actually not been a transaction to realize. It's all unrealized. It's just on paper. There is this gain reported as income. Okay, good. 9.4.
9.4 is what does significant influence imply regarding incorporate investments? Describe the accounting procedures used for such investments. Significant influence is when investors own 20 to 50% of voting shares of the investee, and the accounting method or accounting procedure used is the equity method.
Yep, sounds good. Okay, and then you have this what looks like a monster, 914.
Yeah, it was actually for multiple choice questions for the most part,
Okay.
besides A. It's a lot of reading, so I won't read through it all,
Yeah,
but
any lessons to be learned from this? Can you just summarize it?
yeah, so it's and there's asking questions. Majority of them were just covering the available for sale securities. I think
Mhm.
all but the first question, actually, no, all of them were covering available for sale securities. And then it was just asking kind of 4 different questions regarding those
Okay.
securities.
Yeah.
So A is essentially just asking of the 5 or of the 6 different types of financial instruments below, what could be used for available for sale securities. This one I didn't really have a great idea on. I put down 1, which is bonds issued by U.S. corporations,
Yeah.
5, which were municipal bonds,
Mhm.
and 6, which were treasury bills.
Yeah.
I didn't know if securities by foreign governments could be used. And then as far as bills go, I don't know if there was like a certain amount of time that needs to be held, or
Yeah.
if it's just any type of debt.
Yeah, I would say you're right, and I would probably classify 4. They're trying to be tricky there, but a debt security, right? That's
Okay.
so, but definitely not 2 or 3.
Yeah, I shouldn't think it'd be those 2.
Okay.
And then B is just a kind of a true or false, or which one of these is true, regarding the securities held in available for sale portfolio.
Mhm.
For that answer, I got 4. So at December 31st, 2018, the fair value of security was 194 million, lower than the value at December 31st, 2017.
Okay.
That
That's
one
okay.
I just looked at and it seemed to the most right, or made the most sense of the other 3.
Yeah, I'll take your word for it. Okay.
And then
Yeah, and then the next 2 questions were just like similar, look up at the balance sheet or the cash flow. Okay, good. Well, we don't have to recap that. Thank you for tackling it. I saw all the words and I was like, oh my God, but it looks like it's pretty simple overall. Okay, who has Q 9-5?
Yeah, I have it. So 9-5 firstly was about the investment of TSA company in green company. So as on 1st January, the company had purchased 30% of common stock for 1.3 million cash. So on that date, the cash decreases and the non-cash asset increases by 1.3 million. And then the company ownership allows the TSA exert significant influence for the green company. So during the year, the green company reports 220,000 of net income. So I just multiplied 30% of it, which comes up to $66,000. So in the TSA balance sheet, non-cash asset increases by 66,000 and earned capital increases by $66,000.
Mm-hmm.
And parallelly in income statement also revenue increases by $66,000. Then the green company paid a dividend of 42,000 cash dividend. For that also, even I multiplied 30% and I got 12,600.
Mm-hmm.
In which in balance sheet cash increases by 12,600 and the non-cash asset decreases by 12,600.
Mm-hmm.
Then at the end of the balance sheet, the total value of investment comes up to 1,353,400.
Okay. Yeah. Sounds right. Your
Yeah,
numbers,
so,
I don't know if the numbers are right, but how it affects the balance sheet is perfect.
okay. So
And
that was the 9
where's the Excel? You normally have an Excel for us that you work it through.
No, actually I wrote it down this time in the book.
Okay.
So
all right.
I didn't.
What's the next one?
Okay, so the next one was 9.6, which was what accounting method is used when a stock investment represents more than 50% of investee company's voting stock and allows investor company to control the investee company. So the question only defines it has control in the investee company. So consolidate accounting method is used in such cases.
Mhm.
So why? Because the investor has an ability to influence the investee decisions. I mean, investment decisions and all the management decisions and all.
Yeah.
Then they have the influence of investing company in financial results, and even they have the right of residual returns too.
Okay.
And last one was they're exposed to variable returns, like they even share in profits and even the losses.
Yep.
So
All right.
that was the reason consolidate accounting method is used.
Yeah. Okay. And then what was the next question you had?
It was 9:15.
Mhm.
It was basically the continuation question of 9:14, wherein it was asking about the derivatives and hedging. So it says refer to the information of Amagen in M914. The information reports activity related to Amagen's cash flow hedges. So explain how this type of hedging works. So provide an example of how Amagen might use this type of hedging strategy. So basically hedging means like to mitigating the risk exposure by purchasing financial securities which have a negative negative correlation to the high risk.
Mhm.
So, in short words, we can say that mitigating the risk of financial securities. And even we know that transferring of risk is also called as hedging.
Yeah.
So yeah, that was the answer for that. And yeah, basically investing in a negative correlated stocks or financial securities is called hedging. And then in the next question, how did the hedges affect net income of 2018? I was a little bit confused with this because over there in cash flow hedges, it says 241 in a positive. So I felt it increases the net income. I mean, in other words, it has stopped the net losses going down by $241.
Yeah.
Uh,
Yeah.
is
Yeah,
it
that's
correct
exactly
or
right. Yeah. So
okay?
it decreased their losses by 241. So that worked
Yeah,
out
so that
pretty
was
well for them.
yeah, so that was B1. Then in C, if these same hedges had instead been fair value hedges, what amount would have been added to AOCI of the year? So exactly, yeah, the amount I couldn't calculate, but I can say that when it is treated as fair value hedges, both the derivative and recognized asset or liability are reported in the balance sheet. And yeah, the changes in fair value of both are recognized in the current year earnings.
Yeah. Okay. Thank you.
Yeah, that's what. But I couldn't calculate the exact amount.
Yeah, that's fine.
I fell short of time.
I just care that you get the concept.
Okay.
All right. Who had the
Yeah,
next
so
one?
that was my questions.
Great. Thanks, Nathan.
Yeah.
All right. What is the next one?
Should be
9-7?
Yeah, it should be me for 9-7.
Okay. Go ahead, Chris.
So underlining objective of consolidated financial statements, I said make informed economic decisions, help portray financial positions, so help users. And then 9-8, what is a derivative? Derivative is a security contract whose value is dependent upon one or more underlying assets, and it's used as an insurance policy.
Okay. Yeah.
I had 9-17 as well.
Okay.
So this was the Concord company. The first question A was what amount does Concord report on its balance sheet for the investment in Bloomingdale at year end? I used the fair value of Concord's investment. I said 2.4 million.
So why did you use fair value?
I'm not sure. That was like my guesstimate.
Hold on. Okay, continue to come fair value account towards investment. Okay. So the first question is, okay, so first question is what amount? Were you able to figure out the amount to report?
I may have switched to the next one. It was what amount of income from investment does Concord report for the year? I'm not sure if that's the 2 million cash. Or if they're reporting, because they invested in Bloomingdale, if they're reporting Bloomingdale's income. Or like in terms, because they invested in Bloomingdale, if they're reporting Bloomingdale's, yeah, income.
Yeah.
So I'm not sure about that one.
Yeah, so we don't need to get into it, recreate it all, but essentially what we're going to be doing here is looking at all right, because we're looking at the equity method, we're going to be looking at they own 30% of the book value. So 30% of everything is what we're going to be looking at. So 300 Bloomingdale reporting an income of 300,000, right? So 30% of that, 100,000 in dividends, 30% of 90,000 to 30,000. So that would be 130,000 would be the net income for the year. Yeah.
And then C is the fair value. Is that reported on its current income?
Yeah. So what do you think? Is fair value reported on income of equity?
I said, yeah, I thought in that last slide picture you had, it was it slid over to the income.
Yeah. So I think what is confusing here, and I get it, when I first read at this question, is it seems like they're confusing the two concepts. Let me share the screen here, because they're doing the equity method, but then they throw in that fair value. So that fair value though is not the method we're using. We're using the equity method. So what you can see here is looks very similar to this. They purchased 30%, right? And then number two here, the value went up by 100,000 or 300,000, and they have 30% of it. So that would be it would be 100 income, right? And then they have the dividends. They get 30% of those dividends, so they would have a cash increase of 30,000, but a decrease in their non-cash assets of 30,000, right? So that is what we're doing here. Now the question is, what then unrealized gain of fair market value of Bloomington. So with the equity method, we don't really care about the fair market value. So it is not reflected on either the income statement or the balance sheet. So it's
okay.
It's number one. All right. Yeah. So I don't know if they're trying to throw you for a loop, throwing in two different terms that have different meanings, or what, but that's what they're doing. We really, with the equity method, we ignore the fair market value.
Cool. That was it.
Okay. Who's next? Do we hear from you, Cal?
Not yet.
Okay.
I got a question 910,
Mhm.
and that asks what are the limitations of consolidated financial statements?
Yeah.
And I put the first was consolidated statements does not imply that the parent company has received any or of the subsidiaries net income as cash. And the second one is it makes it hard for comparison between companies because they have different mix of subsidiary.
Mm-hmm.
And then third, the consolidated numbers can mask poor performing subsidiaries whose losses are then offset by the positive performance of the other one.
Yeah. That's true.
9/11, I have, how does a weakening US dollar affect the consolidated balance sheet of a company with foreign subsidiaries? So with the so when the US dollar is weakened, the foreign subsidiaries assets and liability increase, as does the stockholders' equity. And that increase is evidenced by a positive cumulative translation adjustment on the parent's balance sheet.
Mhm. Yeah.
And then the last question I had was 9-18, and that's to compute computing income for equity using the equity method investment. So cross company purchased an equity investment in panel company at a price of $2.5 million, representing 40% of the book value of panel. During the current year, panel reports net income of $300,000 and pay cash dividend of $100,000. And so the question asks, at the end of the year, the fair value of Cross's investment is $2.65 million. So what amount of income does Cross report relating to this investment in panel for the year? And so I just took panel's reported net income of $300,000, and I took 40% of that, because Cross has they purchased 40% of the company, and so I got equity income of $120,000.
Yeah, that sounds right.
Yep, I think that was all
that
the
the whole
questions I
question?
had. Yeah.
Did you factor in the dividends?
No,
Okay.
because
Yeah, so
there wasn't. I think it wasn't.
yeah, so
The dividends are not the investments. That's what I believe.
okay, so yeah, I don't think your answer is wrong, but just to be very clear, the dividends are not recognized on the income statement, but they are recognized on the balance sheet. So depending on how you interpret this question about what amount of
Mhm.
income do they report, they only report the 120 on the income statement, but on the balance sheet they would report the 120 and the dividends, their portion of the dividends. So I guess I don't know if it's not clear to me when they ask what amount of income does Cross report, if they're saying income on the income statement or total income on the balance
Mhm.
sheet. So anyway, all right, did everyone do their questions? I think so. Okay, so next week, remember next week we are going to skip chapter 10 and we're going to go straight into chapter 11. All right, see you guys in 1 week.
Yeah.
Have a good night.